This is a podcast by the Straits Times.
I was talking to my colleagues at lunch recently, and I heard a story about one of his friends. He had started with $5,000 in 2021, and by the end of that year, he had grown it to $500,000, right? And he was on track to having $1 million by the time he was 35 years old. But then 2022 came around and back to $5,000. So he crashed, and he crashed hard. And honestly, I think it's a bit more painful to have had it and lost it than to never have had it at all.
I often speak to lots of investors and finance personalities. One of the main things they will say is, invest for the long haul. Put your money in and leave it there and reap the benefits of compounding. One that really sticks in my mind is ex-F1 champion Nico Rosberg, who told me that he invests in the S&P 500 because no matter the current market volatility, the value of the stocks will have increased compared with a decade or so ago. But what does that all even mean? How long is the long haul? And why does starting young matter? Hi, I'm Suen Tan, and you're listening to Headstart On Record. In the studio with me is UOB guru Gidon Jerome Kessel, Head of Deposits and Wealth Management, and young investor Leong Keet, who is also a financial blogger at SG Money Guide. So hi Keet, can you tell us what you invest in now?
Hi Suen. Yeah, sure thing. Currently, I invest in 4 stock ETFs, and they're all listed on the London Stock Exchange. So I'm just going to list out their names and what they are. So the JPGL is a fund that tilts towards profitability and value. I also invest in AVGS, and that is a global small cap value fund. Thirdly, I have IWMO that targets momentum. And finally, for my emerging markets, I use DGSD, which is another small cap value, but targeted for emerging markets only.
Okay, and would you say that these are all long-term or short-term holdings?
Yeah, you're absolutely right. These are all for the long term, right? For short-term holdings, I actually have a high-yield savings account, right, for short-term expenses. So these would be things like renovation, right, or weddings. And in general, all the expenses that are coming up within the next 3 to 5 years, as well as anything that just crops up in day-to-day living. So that really sets it apart from all the stock ETFs. Now, those are indeed for the long term.
Okay, and why do you choose to think of investing in something that is such a long-term endeavor then? Because there are also people who like to play, for example, like short-term trading, or they want to make a quick buck, right?
You know, you're very right on that. I was talking to my colleagues at lunch recently, and I heard a story about one of his friends. He had started with $5,000 in 2021, and by the end of that year, he had grown it to $500,000, right?
Wow.
And he was on track to having $1 million by the time he was 35 years old. But then 2022 came around and back to $5,000. So he crashed, and he crashed hard. And honestly, I think it's a bit more painful to have had it and lost it than to never have had it at all. So these kind of stories, they remind me that even though the big gains sound really appealing, and we always hear about those who win it big, but with big gains come big risks, and you can't have the big gains without the risk as well. So I don't think of that as reasons for me to chase short-term investing. I think that's a bit more like gambling to me. And there's nothing wrong with that because I love the Hong Pao draw every year, and I'm happy to participate. But I do think that Toto does not form part of my long-term investing plan.
Wow, okay, very well said. Okay. And for Gidon yourself, what are your thoughts on long-term and short-term investing? And what do we actually mean when we say investing for the long term?
Yeah, so look, I think a very good question. And look, thanks for having me. So I think typically, long-term investing entails buying and holding an investment for an extended period of time. So that could be 3 years, 5 years, even decades. It really then depends on one's objective. It could be retirement, it could be marriage, it could be buying a property. But generally, the principles of long-term investing is allowing your investment strategy to breathe. So it allows time to compound, benefit from compounding, which in essence is a return on a return. So for example, if you're earning interest, dividends, distribution, you reinvest that, and then of course you compound the return over time. So that's proven to be very powerful in the long term in terms of wealth accumulation. I think beyond that, it allows you to then weather different market cycles. So I think as mentioned before, you'll have volatility. I think in the example cited, which is all too common, certain people or investors will be quite aggressive, yield some big returns, and then inevitably they lose it over a short period of time. So I think generally long-term investing is synonymous, A, with an objective and a purpose, B, allowing your investment strategy to breathe, and then really benefiting from the power of compounding. And then, of course, that period may differ by each person's objective and purpose. So I quote Warren Buffett. It was back in the 80s where at a chairman's meeting, he made the statement that his time horizon is forever. So as long as he feels there's value in a blue chip, top quality company, he's quite happy to keep it indefinitely. So you sort of see that extreme. But generally, I think it's more around a purpose and a discipline.
Okay, and I think we've heard from Keet on the examples of what he holds for the long term, right? So are there any other examples of long-term investments that you can talk about?
Yeah, so I think it really comes firstly down to one's objective. So what is your objective of investing? Again, is it thinking for retirement? Is it pure accumulation? Is it income? Is it saving and investing for a certain life event, whether it's marriage, property, and so forth? I think from there, then it's really defining your risk appetite, which we just heard actually quite aggressive, which isn't a bad thing at this life stage because you have more time to let your strategy breathe. But different people have different appetites and risk profiles. So I think it's really establishing what are you willing to lose to ultimately then gain per your longer term objective and purpose. So if, for example, you're more conservative, you still may want to go into, for example, a bond fund or a bond tracker ETF, have some portion, for example, in saving bonds, T-bills, vis-a-vis someone who may have more risk appetite, a longer time horizon, where you'd perhaps look at certain equity ETFs, unit trusts. You may look at specific sectors, geographies. But ultimately, we always suggest to have a diversified portfolio approach. So to that end, it will immunize any potential volatility, which is inevitable.
And is there any certain fixed time horizon that we call it long term? So I think you mentioned 3 years, right? But sometimes people think of long term, they think of over decades. For example, if we say we have invested in the S&P 500 two decades ago, right now it would have grown by so much.
Yes.
But if we talk about 3 years, then we would actually see the volatility and there might be a fall, right?
Correct. So, and it's a good question. So it often comes back down to your objective. So for some, there may be an objective, okay, I want to buy an investment property or my residential property first home in 3 years, 5 years. Beyond just putting in cash or deposits, it may not yield that return you wish. So that may be at certain time horizon, you'll invest to achieve a certain yield and to put down a deposit on your property. But then more broadly, for example, for retirement, it's a much longer time horizon. So one may even be a bit more aggressive, really focus on capital appreciation over a period of time. And then to your point, it negates volatility. And if you reinvest and, you benefit from the compounding, and you gave a classic example, just an SPX tracker or S&P 500 tracker, you see that benefit, over time. But then, of course, always overlaying a discipline, which I always think is great at a young age, building those healthy habits to put a little bit of your money away, your take-home pay, rule of thumb is 10% and above, each month. It builds that discipline, it accumulates, you benefit from compounding. And before you know it, you see your wealth grow, over time. And volatility becomes less of an issue, the longer you invest.
Okay. And for Keet, I think you mentioned the holdings that you have on the London Stock Exchange, right? So how do you choose those holdings in the first place?
Well, actually, those particular holdings come from my own personal conviction about what makes for higher returns. So I believe that certain characteristics of stocks will make them have a higher return. So firstly, equities in the first place earn a higher return than bonds because they are riskier. And that is a sort of systematic risk that cannot be diversified away by just buying more and different kinds of equities. But I also think there are other forms of systematic risk that are present in certain kinds of stocks with certain kinds of characteristics. So I've specifically chosen these particular funds to just have a slight tilt towards these particular factors, of which some would be value, profitability, as well as them being smaller size in nature. So in all, these 4 stock ETFs are really targeting not just equities in total, but certain risk premiums that I believe will have higher returns in the future.
Wow, okay. So you really did your research to see that this is going to grow and compound over time, right? And that's why you hold them for a long term and then you hope that they will give you higher returns towards the end. Is that the strategy?
Yes, that's absolutely right. And actually, I can build upon Gidon's point that the long-term horizon can be really long-term indeed, and we should actually expect our investments to underperform from time to time. And the reason is really simple. Because if it outperformed all the time, people would just flood into these investments and there would be no risk premium left after all. All right, so if somebody comes to you and says this product can give you a higher return guaranteed, that's a Ponzi scheme. So please be careful.
Wow, okay, that's a really interesting point actually, because I think you are also speaking to all those people who, for example, they read on Reddit, right, that this tech stock is going up and then everybody floods into it. So that wouldn't really be considered a long-term holding in that sense. Gidon, do you want to weigh in on this point?
Yeah, no, I think very good points sort of raised, and very impressed at how informed you are as well, which I think is good. So I think the more informed you are, the more knowledge you build, inevitably leads to better investment decisions. So to your point, it's not following, for example, the herd mentality, where again, there'll be, a fad stock, everyone jumps into it, and inevitably, there'll be some form of volatility without an objective really being attained. From time to time, however, one does need to relook at one's portfolio holdings. There may be times where it's appropriate to rebalance. So I think I heard you mention you hold a small cap ETF as well. So you may find at some point, the small caps may become medium caps, and then the fund dynamic return performance may change over time. So investing is always fluid. So whilst you may still have a buy, hold, long-term approach, which is prudent, it doesn't mean one should not review your holdings, your portfolio, calibrate where appropriate.
Okay, and are there certain asset classes that are more for long-term trading and long-term investing, I would say, and more for short-term trading, for example? So, I mean, crypto, would we consider that long-term? How about ETFs, bonds, funds? Where do we place them?
Sure.
I mean, some people invest in gold, right?
Of course, yes.
And where do we place that as well? Are you able to speak more on the asset classes themselves and which ones lend better to a long-term holding?
Yeah, no, indeed. And some of these solutions are more wrappers. And then, of course, there's various asset classes within. So whether it's an ETF or a unit trust, for example, you typically will have the whole spectrum, whether it's money market, T-bill type funds or ETFs, through to your multi-asset, right through to your very exotic, whether it's sector or geographic specific solutions. And then to your point, you have some of those more short-term sort of underlyings like crypto, which in some cases we don't even have, or banks, investment houses will not even have a view on.
Right.
Because it's very opaque at times.
Yes.
So, but going back to the basics and the discipline, in my mind, align with objectives, purpose, ideally diversify where you can. And then again, whether it's income, appreciation, you have a multitude of solutions. So if you're more income biased, for example, you'd look at fixed income or high dividend, good quality equity funds or ETFs that generate good income. If you're at a younger age, you have more risk appetite, you have a longer time horizon, then emerging markets, small caps perhaps make sense because the risk reward is quite different. Whereas for day trading, it's quite nuanced and specific. Inevitably it requires a lot more monitoring, a lot more transactions. There's a cost to that. It's a full-time job in my mind if you really want to do it properly. And it's not to say you can't make money, but naturally it's risk reward. There's a much higher risk vis-a-vis what we're discussing longer term.
Right. So what I'm hearing is it's not about the investment itself, but it's really your perspective towards it, right? And the objectives that you have. So for example, if I buy a bank stock, I can be a person who wants to use it for day trading, or I can be the person who wants to hold it for the long term to see how it compounds.
Exactly. And then you may have different solutions on that one bank stock that may, again, fit different objectives.
Right. So would you say that it is more appropriate then for most general investors to hold for the long term rather than trying day trading?
Yes, definitely. I think it's a proven long-term strategy that wealth typically accumulates through this compounding effect, particularly if you overlay with diversification. The other thing which I was also impressed in our discussion earlier, although you didn't mention it now, you're even thinking about retirement. So putting certain contributions to your CPF, doing it at an early age, and all too often at a young age we forget about it. So even my personal experience, when I first started working, didn't give it too much thought. It was pretty much whatever I earned I was spending. But then over time, I built that discipline, to do a regular savings plan, a number of funds as well. At a point in my life, I was allured by day trading as well. Not that I necessarily had the time. And it was fits and spurts. Some weeks I made money, other weeks I didn't. But ultimately it wasn't sustainable. For the reason I didn't really have the ability and time to focus on it. And, market timing ultimately never works long term.
Okay, and Keet, I think you also mentioned having high-yield savings accounts, right? And some people do actually consider that to be an investment in itself or a long-term investment in itself. I mean, what are your thoughts on that?
Well, a high-yield savings account is a good part of a retirement plan, but it definitely shouldn't form the majority. And that's for a very simple reason. It's one of the riskiest things you can hold. And that's a pretty controversial statement.
Yeah,
so
yes.
Let me explain that. Risk has many forms, and the one we most commonly think of is volatility. That is, seeing the value of something go up and down. And the real allure of cash, especially the kinds that are in our savings accounts, is that it just stays there behaving nicely and it doesn't go up and down crazily like those stocks or bonds or funds do. And so for a person who needs to fund short-term expenses, which is, all of us, unless you happen to be Piyush Gupta or someone of that caliber,
Yes.
Then for all of us, I think a high-yield savings account really makes sense in helping to fund our day-to-day expenses or even our large lumpy expenses that come up from time to time. Like that time when my fridge broke and you can't wait on buying a new one because there's a lot of things in that fridge, you realize, and they are not staying put for long.
Right.
So when that happens, right, high-yield savings account are the perfect solution. But for a long-term investor, especially one that's looking at retirement, risk is not having the money when you need it. So in the short run, having that money is really helpful. But in the long run, your high-yield savings account is at risk of losing value to inflation, right? And in 1/4 of the cases in history, we find that actually savings accounts cannot even keep up with inflation. So you are literally losing money to inflationary forces. All right, and that is a really big risk for someone that needs to fund their retirement, which is also something we don't know how long it'll be. And, having too much money is not so much of a problem as not having enough money when you're in retirement, especially when you're older, frailer, and unexpected expenses might hit you when you're least able to do something about it. And so that's why I think having a high-yield savings account as a primary tool, right, it's one of the tools, but it really shouldn't be the primary one in your long-term retirement savings.
Yes, that's very well put as well.
Yeah, and then I'm very impressed at your thought process. I think, with anyone's investment portfolio objective purpose, there's always some need for liquidity as well. So I think whether it's high yield accounts, saving accounts, typically you would always allocate some proportion of your holdings for those unexpected emergencies, even at times to then, again, not being too technical, having some dry powder to then invest at a later point. So, I always think some liquidity is needed, but to the point you mentioned, which I think was very pertinent, you have to factor in inflation and, other variables that you ideally can't put all your holdings in cash because ultimately it just will not accumulate to the point, to sustain your retirement or certain life stage events or expenditures.
And Keet, it's really interesting that you talked about really investing for retirement, right? So it means that the long in your long-term investing is really 30, 40 years, maybe even 50.
That's right. So we don't actually know. I don't have a crystal ball, or if I do, it's a bit broken, so I really can't see into it. But it could last a really long time. And maybe I could hope to one day reach age 100, and maybe I'll be invited to the National Day rally too.
Wow,
so
yes.
Our long term can be really long indeed.
Yeah, okay. And is it rare that you are in your 30s and you're already thinking about retirement or you're already planning towards retirement?
I don't think that this is something that hasn't crossed people's minds. So I do hear it being brought up every so often. But people tend to stop at the question of what do I invest in, rather than saying, how do I fund my retirement? So they don't take a step back from the what to do to think about the why they're doing it. And that question is actually a lot more complicated than it seems, because thinking about my retirement actually means thinking about what I want to do with my life. So that's a very complex question that I don't think I have the answer to right now. But I do know that I hope to foster cats in the future. So at least that is one portion that I'm thinking about. The other part is I would really love to sit first class somewhere and buy the suite, just for the heck of it. So I think those are the two things I've decided on for now.
Okay, those are great, like long-term investing goals, right?
No, indeed. And I think, again, very pertinent from Keet in terms of the why, not so much the how. So often we ask the why when it's too late. So when you're nearing retirement, then often that becomes more pertinent. But then the how is there, but then it's, you may not get that accumulation to then sustain your retirement and lifestyle that you desire. But if you start early and you ask why, inevitably it forms a better outcome.
Yeah, I think that's a really important point that both of you brought up, right? That is about the purpose and the objective of the investment and not just, okay, let's invest something, let's make some quick money right now. But it's more of what is this money going to be for? How much do I need? And what do I use it for in the future? And what does that future even look like? Which I think Keet painted like a really interesting picture of what that future will look like. So that's really good. But also, Keet, how do you then deal with the temptation maybe to do some quick investments, especially when we see the market volatility these days, right? I think this year especially, there's just so much that has been happening in the markets. Like, are you ever tempted to, let's say, pull out your investment if you see that it's been going down? Or are you tempted to invest in something quick because you see it's going up?
For that matter, I think it's quite natural to react to the tendencies, the daily fluctuations and noise within the market. I think that's only human because we will see incredible things happening like Liberation Day, which happened recently earlier this year. And of course, there are all these questions about, well, what do I do now? And that's a very normal reaction because normally when something big changes in our world, we like to think about how do I react to this. But investing is a little bit different because you're not concerned with the world as it is right now. You are concerned with how the world will be 20, 30, 40 or 50 years into the future. And if you think back to the past 20 years and I ask you to think about the things that mattered, you will not be mentioning a lot of events. You will have, COVID or the global financial crisis, maybe a couple of wars, right? But a lot of the other stories just fade out into the background because in the end, they weren't really that consequential. And nobody is looking out for the things that are consequential because if we see it coming, then we can mitigate it and it won't have that much of an impact at all. And I think that's why an event like the global financial crisis or COVID, it hit us really hard because nobody thought it would happen. And then when it did, we were all unprepared for it anyway. So I don't think reacting to the market in that manner is actually the best way to handle your investment strategy, as tempting as it may be. On the other hand, if you find that you can't sleep well at night when it comes to your investments because they're moving up and down too much, then I think that is valuable information. You've learned that your own risk tolerance is probably a little lower than you thought it was. I can't remember if it was Farmer or French who said you can learn a lot about yourself in a bear market, right? And so when you learn that your risk tolerance is actually lower than you expect, then by all means, please make that change. And the important thing is you actually stick to that by lowering the risk allocation within your portfolio, for example, by buying more bonds and less stocks, all right? But when it goes back up, don't be tempted to go, I have a high tolerance for volatility, but only the kind that goes up. So I think that is how we should approach our investments. And, you should only take the amount of risk that allows you to sleep soundly at night. Because if you can't stick with it, you're not going to capture the returns.
Wow, yeah, that is really insightful. And that is so true, right? That people, when it comes to the bear market, then maybe they start to panic and then their risk appetite drops. But later when everybody is buying again, then they go all the way back in. And that is so true. Yeah. So, for Gidon yourself, we've seen bigger market swings these days. And I think we've even talked about how with geopolitical tensions, tariff uncertainty, so much that is going on with policy changes that has created such greater market swings than perhaps we saw in the past, right? So how should investors respond to these swings?
Yeah, definitely. And I think, Keet articulated it very well. I think volatility is inherent with investing. It's always going to be there at some point. And I think, as mentioned, the various macro triggers, whether it's conflicts, wars, policy implementation like, Liberation Day, Trump tariffs, through to black swan events like COVID. But that will be there, and you don't necessarily need to be scared of it, and particularly if you have a sort of a longer-term view. Other strategies that one could deploy is regular saving plans. So using a bit of jargon, dollar cost averaging. So the premise being is you invest a little bit every month and you buy in, or could be quarterly, but you have some form of periodic sort of saving plan rhythm, and then ultimately it smooths out the price you buy in, whether it's an ETF, fund, and so forth. So you have these various mechanisms that can help manage volatility. I think if one has a longer-term view, you just need to accept it's going to be there. There'll be the ups and downs. But ultimately, through a very disciplined, diversified approach, I think history has proven, one can accumulate a lot of wealth. You can reach your sort of risk-reward objective, whatever that return band may be. And inevitably, it presents opportunity as well.
Keet, now you are in such an expert place, you've done your research, you know exactly what you're doing. But how old were you when you first started thinking, maybe I should invest in something? And do you remember what was the really first thing that you bought?
Thanks for that, Suet. So I was actually just fresh out of university, and wouldn't you know it, there was a certain global pandemic that had shut down everything, right? It really was everything. And so I had just gotten my first job, and I was a teaching assistant in NUS. But back then, all the lessons were online. And so after my lessons concluded, I turned off my computer and I went, okay, what now? So I didn't have a lot of things to do because we were all stuck at home, and there's only so many online games you could play with your friends. And I had this bank account that just kept growing month after month because you couldn't go out and spend it anywhere, right? So I was thinking to myself, hey, I should do something about this. And the first thing I did was I went to search how to invest. And one of the suggestions, which I thought was very sensible, is, you should use a robo-advisor. And so I went and put, $1,000 into the robo-advisor. Because, contrary to my investment strategy, I am not a risk taker in my personal life. So I just tried it out first. And I watched as that $1,000 turned to $1,050, and then $950, and then $900. And then I thought to myself, wait a minute, I thought they were supposed to be able to avoid these downturns. But that actually got me started into thinking more about investments. And I was thinking, is this really the right way? And I had all these questions in my head. So I started exploring this area of what to do with our personal finances, how to invest. Like the people I mentioned earlier, I also started out with the question of how to invest. And back then, you couldn't really do anything. You couldn't even buy a PlayStation 5. It was so popular and it was so sold out. So I can't even play games at home, right? So I had to get out of the house. So I would take 3-hour hikes because I love going to MacRitchie Nature Reservoir. And I would just pop on an investing podcast or two as I walked around the whole reservoir. And that's where I really started my journey into investing. And from there on, I discovered some really fine podcasts about, and I read all of the classic books on investing. And that's where I started to learn of all the basic principles of investing from there. And really, I was so shocked that it was really easy, because anyone can do it in the same way that anyone can run a fitness workout. You don't need to be a trained physiotherapist to, have your own fitness session at home. And in the same way, you don't need to be a trained finance professional if you follow the correct principles. But there is a lot of noise out there. So I really understand that people do struggle to find what is the appropriate way to begin investing at the start, because I was very confused for a long time. And I only landed on my current strategy in 2023 and maybe early 2024. So I'm glad to have stuck with it until now, and hopefully for quite a long time afterwards.
That's so interesting, because I also started with a robo account, and I actually opened it because I wanted to write a column about it. So that's how I started investing.
How was your experience?
It is the same experience as his. So it went up and then it kind of went down, and for a couple of years it was down. But I'm pleased to say I did not take out the money, and it's actually up now. So
good.
So maybe that's what it means, right? Investing for the long haul.
Yes, indeed.
Yeah. So Keet, let's say I'm a first-time investor, what do I have to do first? Do I open a CDP account first? What are the steps I have to go through?
So a CDP account is an account for you to own SGX stocks. So those are the stocks listed on the Singapore Stock Exchange. But that is not necessarily needed. I do find that having a CDP account is helpful because it gives you access to, I believe, savings bonds. Correct me if I'm wrong. So that's actually one of the low-risk options that are available for retail investors, and they belong to the government. So it's an excellent option for people who are, quite rightfully so, I must add, scared of maybe having bad experiences with financial institutions, right? Because there have been a lot of cases where people have experienced fraud or products that really haven't panned out. But nowadays, there are plenty of robo-advisors, and as a start, I would say any one of them is not a bad choice because you're really getting started out, and don't let perfection be the enemy of good. So I would advise having some sort of access to a unit trust platform. I think those are absolutely the most beginner-friendly. So you would contribute $100 a month, $200 a month. And that really brings me to the second point, which is that you must have money to put into investments. If you spend more than you make, then all of this is not an option for you, right? So the very first qualification for doing any of this is actually to make sure that you have money to put away. Because if you don't, then something needs to change, right? Because you are headed down a slope, and it's a very long and slippery slope.
Yeah, so for Keet yourself, I think you mentioned podcasts, right? But where do you get your financial advice from generally?
So the one podcast I'd like to give a shout out to for all of this would be the Rational Reminder podcast. And it has truly led me to all of my financial knowledge. I'm not kidding. It is where I started from. And nowadays, I have built up a solid foundation of financial knowledge that I think everything else is just building on to that solid base, that where it came from. I also like to read what our government puts out. So that's in money sense, because I know that's like government-endorsed advice, although it does tend to be a little general, right? So I find that it's more targeted to the average person on the street, which I think is very sensible. At the same time, the banks, I do agree, they have put out a lot of snippets of education, bite-sized investment advice and savings advice and personal finance advice, and all of those can be really helpful. The only challenging part is, of course, distinguishing the sort of information out there with, shall we say, bad actors or people who promise to make you a quick buck. And here, the general adage. The general adage comes into play, which is that if it is too good to be true, it probably is.
Okay, yeah, this was really helpful. Well, that's a wrap for this episode of Headstart On Record. Thank you, Keet.
Thanks, Sued. It was a pleasure.
And Gidon.
Thank you. Lovely being here.
It was a pleasure talking to you too. I'm Suen Tan. You can email us your thoughts on this issue or suggest another question you'd like to see me tackle next time on the show. You can also reach out to me on LinkedIn. And if you'd like to read my articles and the Headstart newsletter, all these links are in our podcast show notes. This podcast episode is edited by Amirul Karim. Stay tuned then. Thanks for listening.
Send your feedback to podcast@sph.com.sg. Find us on Apple Podcasts, Spotify, or within our Straits Times app. Thanks for listening. Do note, all analyses, opinions, recommendations, and other information in this podcast are for general information purposes only and are not intended to be relied upon as financial advice. You should not rely on them in making any decision. Please consult a fully qualified financial advisor or professional expert for independent advice and verification. To the fullest extent permitted by law, SPH Media shall not be liable for any loss arising from the use of or reliance on any analyses, opinions, recommendations, and other information in this podcast. SPH Media accepts no responsibility or liability whatsoever that may result or arise from the products, services, or information of any third parties. All opinions expressed by participants in this podcast are solely their own and do not reflect the opinions of SPH Media.